Hi, everybody. Patrick Prunty here speaking. Had a couple of technical difficulties getting started, so I appreciate your patience. If you could all do me a favor and type into the chat box and let me know that you can hear me okay and that you can see my screen, I'd greatly appreciate it. While you're doing that, I'd like to take a minute again to thank you all for being here tonight. I'm just super excited to be with you all. We just have a wonderful, wonderful presentation. A lot of you have seen this. I've talked to a lot of you, and we've just had an overwhelming response to this program, which I call How to Collect Mailbox Money. And it's just an amazing opportunity, and I challenge a lot of you to think a little bit differently in terms of what it is that you want to do with your investment dollars. We all work so hard to save money, to have a budget, and when it comes to your investments, you have to be extremely prudent. So again, I'm super excited about this program, and I want to thank you guys all again. Without further ado, we're going to move right along. As I mentioned, my name is Patrick Prunty. I'm going to be your host tonight, and some things you need to know about me. I'm a veteran of Marshall Reddick Real Estate. I've been here for about 13 years, and I feel like I've seen it all. I'm also someone who practices what I preach. So I own rental property. Most of the properties I own around the country I bought through the channels of Marshall Reddick. I'm a private lender, which I started doing about 6 years ago when I was no longer able to qualify for conventional real estate financing to build my buy and hold rental portfolio. I'm also a broker here in California, and I have the credentials there to back up what I say. So those of you as well, I know we have quite a few from the San Jose Bay Area. I wanted to alert all of you that I'm going to be flying up there, not this coming week, but the week after. February 23rd is a Tuesday. On the screen there you can see I'm going to be in San Jose on Tuesday. I'm going to be in San Mateo on Wednesday, and I'm going to be in Fremont on Thursday. I'm giving a very similar presentation. So I encourage those of you who are there locally to come and say hi. Face-to-face time and relationships are what it's all about. So I'd love to personally meet you and talk to you about this program. One of my goals for 2016 was to practice more yoga, so I've got a little shot on the screen here. But no, really, the reason I have this slide is because I just want you guys to know that this investment really has changed my life, and I think it can do the same for you. Again, you just have to think a little bit differently than the normal, well, I could buy the property and be the landlord, and instead think of it in a more passive fashion about how you can lend the money and be the lender, play the bank. So we are Marshall Reddick. I want to introduce you to our private real estate lending program. And as I go into that, we're going to launch a poll so that you guys can give me some feedback. So I think you can see the poll now. And the question is in terms of your retirement savings, what has been the average annual return over the last 25 years? And I love crowd participation. I'd call on you if this was a live presentation, but it's not. So I'm going to give you about 10 seconds to kind of give me what your return has been in your retirement account, again, over a broad period in the last 25 years. Okay, we've got a good response going so far. Seems like 6% is kind of the high. A couple more seconds here. Okay, excellent. Let's close that poll and let's share the results. Pretty evenly distributed amongst the 3% and the 6%, kind of what I figured. And then a few, about 10% coming in at 9%. So those of you in the 9% range, give me a call. I'd like to invest in what it is you're investing, because I think a 9% average annual return over the last 25 years in your portfolio is fantastic. But in any case, we're going to talk tonight about the private money program and the Mailbox Money program and how you can earn better than a 7 or better than a 6% and earn a 7 to 8.5% return with us with literally little to no risk. Now, there's always a risk, but we minimize it, and there's little to no risk. Thanks for participating in the poll, you guys. Moving along, challenging you, as I've talked about a little bit, make it a goal. You know, those that are successful, set goals. So make it a goal for yourself this year to seek out something a little bit more passive and become a Marshall Reddick Real Estate lender. It's not difficult, and I'm going to show you how. A question I get consistently is, how do you actually make the investment? Well, it's pretty easy. There's 3 ways. You can provide a purchase money loan, which is simply where someone's buying the property now and you're providing the loan into the initial escrow. There could be an existing loan that's already been originated, perhaps we as a business originated or somebody else did, and that's being sold in the secondary market. So you can buy that secondary market, that mortgage in the secondary market and take over that performing payment stream. Third, you could provide a refinance or a cash out refinance loan to an investor who already owns the property. I get this strategy quite a bit with people who buy at auction or at foreclosure sale, and of course they have to use their own cash to do that, but then afterwards they want to set it up with a little bit longer term financing to get their cash back so that they can go back to auction and buy again. Very common strategy. But in any case, out of all 3 of these, you become the bank. That's the key to this whole program. You don't need a bank. You can lend your money and become the bank. Important to note, too, that this is not a syndication. So we're not pooling investor money. You are actually going to be the lender, right? When we talk about a deal, and I'm going to show you some live deals this evening, you actually would be the investor on the paperwork, on the promissory note, on the mortgage or trust deed, okay? We are not, and there's no interest arbitrage. The interest is a straight pass-through to you guys. Before we go any further, too, I just always like to ask the question, as investors, what are we most concerned with? And I should have set up a poll for this one, too. It would have been phenomenal to get your guys' feedback. But for me, bar none, protecting principal. I don't need to be super risky. In general, I'd actually like to be less risky. But number 2, I got to balance my desired risk with my desired return. And that's kind of the happy medium that you guys need to find. And then lastly, we all know we need to diversify. So this Mailbox Money program covers all 3 concerns. And at the same time, as I've harped on a few times already, it really minimizes the risk. These loans that we're talking about, these real estate loans, are ideal for what? Well, for the buy and hold rental property investor. Now, that said, borrowers should always use conventional financing when possible. They only want to use private financing when necessary. Next question. When would a borrower need to use private financing? Now, a lot of people will immediately say when they have bad credit, and that's just certainly not the case, okay? The primary reasons why an investor, a borrower, would need to use private financing, number 1, non-recourse lending. Okay, so this is applicable to those self-directed retirement borrowers, right, who want to buy rental property with their retirement account. Very common strategy. I've done it. But when you do that and you need leverage, you need a loan to help you make that transaction, it has to be a non-recourse loan. And non-recourse simply means there's no recourse against the assets of the IRA or the beneficiary of the IRA. That's a federal mandate as the retirement accounts are protected. Speaking of self-directed retirement accounts, I primarily use mine to do long-term lending like we're talking about tonight. It's just a no-brainer. So those of you sitting out there with old 401ks from prior employers or IRAs that have been started and contributed to over the years, I can help you roll those into a self-directed retirement account where you can participate, become the bank, and collect mailbox money. Give me a call if you want to talk about that. Happy to help. Second item where a borrower would need private financing is if you have more than 10 mortgage properties. Now, Fannie Mae and Freddie Mac conventional guidelines state today that if you have 10 mortgage properties, that you can't qualify for number 11, number 12, and number 13. And that just seems kind of crazy, but, you know, we were burned so badly in the downturn with all the liar loans and everything that they're really gun shy. So no lender can originate a loan that they plan to sell to Fannie Mae or Freddie Mac on the back end if you have 10 or more. So very commonly then you have to go for a private loan for number 11, 12, and so on. And let me tell you guys, I talk to investors daily who are building portfolios of rental property of 15, 25, 100 properties. So the need for private financing is very heavy and readily available. Third is loan amounts of less than $50,000. Okay, understand that the banks don't like to make loans under $50,000. Right? There's just not enough money in it for them to make sense. But those of you who know Marshall Reddick really well, you know, in the markets that we're in, Memphis, Toledo, Clarksville, Indianapolis, a lot of these markets, it's very common to be able to buy a property for $60, $70, $80, $90, $100,000, and you need a loan of, you know, 50 or 60% of that. So it very well commonly could be under a $50,000 loan. Okay, so those are the three primary reasons why a borrower would need private financing. Okay, so let's dive in a little bit into our asset-based lending. Okay, so this is how our program works, right? The return on investment is 7 to 8.5%. And that's why I wanted to ask you those questions, right? So you guys gave me the feedback that the overwhelming share have earned 6% or less average over the last 25 years. Well, wouldn't you like to put some low risk, low leverage loans in your portfolio, collect a monthly payment, and have the security of the property out there to back it up? I certainly would, and that's why this program has changed my life. The loan terms range anywhere from 5 to 30 years. The lower the term, the lower the interest rate, and the longer the term, the higher the interest rate. Now, I want to pause there as well and address another situation. A lot of people say, you know, you're wanting me to lend my money for 30 years. That's a really long time. And I say to them always, you know, if you look into the statistics, the average 30-year mortgage is held for about 7 years. Okay? And with that in mind, you know, they refinance it, they sell the property, they do something where the original lender gets paid off. So I live for the 30-year fixed mortgage that we offer that carries an 8.5% rate. I also advocate it to my borrowers too, simply because they don't have to do anything. There's no balloon payment or no short-term situation that they're not, you know, with the uneasiness in the economy and all these things, you don't want the borrower to be in an adverse position. Okay, so note that our programs are set up with both lender and borrower in mind. We only do non-owner occupied investment loans. Sorry for those that might be interested in a private owner occupied loan. Again, these are for buy and hold. There's always a monthly payment. We have a nifty thing I like to call a 3-year interest guarantee, and I'm going to go over that a little bit later as we get into this. And the maximum loan to value, which is very key, everyone, is 60% of the appraised value. So someone looking for one of our loans, let's give an ease of numbers of a $100,000 purchase, the maximum loan I'd be willing to give them in this program is $60,000. So you can see how low the risk would be if the borrower is putting in 40% of their own capital. So as I mentioned, we have 3 loan programs available. They're very, very simple. The 15-year fixed and the 30-year fixed, of course. And I just wanted to explain the 30-year amortization with the balloon. Okay, so the balloon payment is going to happen at the borrower's choice of either 5, 7, or 10 years. Right? That means at that term that they have to pay off the remaining principal balance. Again, that leaves you some uneasiness, but a lot of lenders prefer that because then they're not necessarily, quote unquote, locked in for a longer period than when the balloon payment time is. All of our loan programs have requirements. Okay, so we talked about the LTV, so which requires 40% down. An important one is that the subject property has to cash flow, right? Again, that minimizes our risk. The likelihood of a borrower defaulting meaning not making the payments as planned, is so low when they have 40% of their own capital in and they have a cash flowing property paying that mortgage payment to you. So we mentioned the 3-year interest guarantee, but also important to note that we require escrow and title insurance. That's a requirement for every loan that we do. Now, those of you who have done trust deed and mortgage investments before, have you ever run into somebody who says, yeah, you know, just send me the money and I'll sign the note, I'll record the mortgage or something? You can't do that. You just got to remember that you got to use that third party and you got to use those protections. So do yourself a favor and make sure that you always use escrow and title. We do. You should too. Homeowners insurance as well. Certainly have to keep the property insured just like a regular bank would. Lastly, we have to approve every deal. Now, I'm an example person, so I'm going to dive into a case study and comparison basically. You know, I love buy and hold rental real estate. I mentioned that I'm a property owner. I have 8 rental properties in various markets around the country right now. But after I've really gotten versed in this private lending, I prefer it. And I'm going to show you why. So let's look first at a single family rental. Standard property, Fort Worth, which is in the Dallas Metroplex, an area that I really like. Okay, so purchase price just under $200K, really nice looking property. You know, this is going to require just under $60,000 down. So you can see that in the investment capital needed there at $58,000. All said and done, after your debt service, because you're using leverage again, you're paying the lender a mortgage payment, and the taxes, insurance, the management, the maintenance, and the vacancy, we're looking at $150 a month positive cash flow. Not bad. Okay, so again, monthly cash flow $150 for a $58,000 investment. Okay, let's look at another option. Now, maybe you don't use leverage. Maybe you're a cash buyer. Okay, I don't think I'm getting off track here. I'm just giving you some examples to compare to. So this standard property in Memphis, right? Purchase is a little below 90, right? So you're going to be putting in just under $90,000, and after, you know, your taxes, insurance, maintenance, vacancy, all the normal things, you're looking at about a cash flow of about $417 a month. Okay, so again, invest just under 90, collect $417. Now, let's look at that same type of dollar figure out of pocket, and let's talk about lending it. So in this situation, we have a 45% loan-to-value private loan paying 7.5% interest. Okay, so this loan amount, middle of the screen there, loan amount says $89,775. So that, as you as the lender, that would be your investment in this situation. Okay, extremely low risk because the borrower is putting up 55% of their own capital, and they're going to pay you $627.72 a month on a 30-year loan with a 10-year balloon. Okay, so in this situation, monthly loan payment $628, just using some rounding there. Okay, I also like to show the amortization schedule because this just blows everyone's mind. Okay, so this is what those payments on that last investment opportunity, that loan that I mentioned. So you see the payments there in the column next to the month, $627.72. The next to that, to the right, is the interest portion of that payment on the scheduled monthly payments. Isn't it shocking how much of that payment is interest? That is all profit. Okay, so I'm going to highlight for you guys that interest column because it's just mind-boggling. And here's a good opportunity to describe that 3-year interest guarantee. So you can see the cumulative interest in the far right column. That interest guarantee is the regularly scheduled payments, the portion of interest over that 36 months. That means that the borrower has to pay you, the lender, that amount before they're able to sell and pay off the loan or refinance elsewhere. They can certainly sell or refinance within the 36 months, but they still have to pay that $19,917.45 guarantee. Okay, here's another example. Okay, very, very similar. in terms of out of pocket. So in this one, we're looking at a 60% loan to value. This is one of those awesome 30-year fixed at 8.5%. Again, don't get wrapped up in that it's long term. This is an amazing opportunity where you'd invest $58,500. See that loan amount, middle of the page towards the bottom. Okay, 60% loan to value. The payment on this, $449.81. So for this one, $450 a month, the payment you collect for an investment of $58,500. Now, let's look at that amortization schedule again. I hit it pretty hard, so I think you guys get the picture. Now, let's dial these back in. Okay, that first one we looked at, the single-family rental property that you're going to buy with leverage. Remember, you invest $58,500, you collect $150, and you got to worry about the vacancy, maintenance, and property management. The single-family rental that you're buying with cash, that's the Memphis one we talked about. You invest just under $90 to collect $417. Again, you got maintenance, vacancy, property management. We all know how that works. Man, dealing with my 8 property managers can get hectic sometimes. Now, let's look at the 45% LTV private loan. Dial it back in. Investing very similar to the cash purchase, except in this situation, I'm collecting $628 a month instead of $417. To me, guys, this is a no-brainer, right? The same amount of capital. I don't have to worry about vacancy, maintenance, or property management, and I collect, what, more than $200 per month? Again, it's those of you looking for passive investments and cash flow. There is not a better opportunity. Rental property will not do it. Rental property is a good investment, don't get me wrong. But those who desire passive and cash flow, you need to start looking at becoming the bank and collecting mailbox money. Okay, last one, dialing it back in. There's that second loan opportunity, 60% loan to value, 8.5%. This one, $58,000, very similar to the purchase single family in Fort Worth that you're using leverage in terms of money out of pocket. And instead of collecting the $150 as the landowner on that property in Fort Worth, this one where you're lending against the property in Kentucky, you're putting the same amount out and collecting $450 instead of $150 without the headaches. Okay. So this is a portfolio that I'm working on with one of my lenders who really gets this, and he's contributed about $250,000 into a situation that he wants me to lend out for him, right? He's got about $1 million in his retirement account, which I know a lot of you do or will in the near future, right? So I'm not suggesting you should put all of your capital into this, but certainly if you were able to put in, $250,000 across 4 different loans like I'm setting up for this individual, you can see that I've got the loan to values there, the loan amounts, the home prices, the term of the loan, right? So whether it's a balloon in 10, it's a 30-year fixed, and then I've got the monthly payments. So you could really build a diversified cash-generating machine with a portion of your retirement account with literally no risk. Okay, so again, I just got to tell you guys, it's a little unorthodox, and a lot of you haven't thought about real estate investing in this fashion, but this is a strategy that you need to consider, especially when using retirement account. Okay, how do you get started? Well, pretty simple. You're going to have a call with Marshall Reddick, so myself or one of your real estate advisor. For those of you who are new to the call, a real estate advisor is simply one of our sales staff that knows all of our markets, knows all of the areas and the properties, and is someone for you to build a relationship with in which to bounce ideas off of and get advice and run your strategies by, and someone to get to know over here inside the Marshall Reddick Real Estate Brokerage. So after that, you express interest, you talk about it, we get your criteria, right? We understand how much capital you have, where it's at, do we need to sell some stocks? Knock on wood, not a real great time to do that, but that market's going to come back, and the volatility in there, I'm not a stock market guy, so I'd like to get into something more fixed. Nonetheless, we'll find out where your capital is. If you need help getting that self-directed, I can help you do that as well, right? Once we know your criteria and what you're looking for, then we can evaluate and present opportunities that fit that criteria. Time is money. You guys are busy. I'm busy. Everyone is. So we need to know that criteria, so we only put opportunities in front of you that make sense for you. Lastly, after we present those opportunities, you get the opportunity to review and to ask questions. I love questions. There's no stupid questions. And I love the investor who asks them, because I know they're doing their due diligence. And that's important, because when I look at an investment, I have to do my due diligence to make sure that I'm comfortable with it, the returns and the risks. Ultimately, you're going to commit or you're going to pass on that loan opportunity that's presented. Okay? What happens next? Well, if you pass, I'm going to ask you why. And I just want to know so I can refine that criteria so that I can only give you deals that are going to make sense for you and that you have the ability to invest in. Otherwise, if you commit, we're going to go through the escrow process, property's going to close, you're going to fund and become the lender, and then what? You're going to collect mailbox money. I'm telling you, it's kind of a funny saying, but really it's a mindset. And you got to be able to put yourself in that mindset to reach the goals and put away the funds that you need and invest your hard-earned dollars. Okay, let's talk about the risks. Always important when evaluating an investment. All right? So we minimize the risk by only lending on Marshall Reddick approved properties. Okay, so we are comfortable in our footprint. You know, so where we know property management companies, where we know real estate brokers, where we know mortgage brokers, where we know title companies, right? Where we know attorneys that are local, right? So we only like to lend in our footprint, and we only deal with Marshall Reddick borrowers, right? So those investors out there that are looking to borrow and want to continue to buy rental property, right, and need these private loans, they've got to be a part of our network. We have to know them, right? Okay, again, loan to value, that's huge, right? The lower the loan to value, the less risk. And so again, at 60% maximum loan to value, you know, if I get a default, I get a borrower that just for some reason decides to not make the payments or something crazy like that, fine. You know what? At the end of the day, I will foreclose on that property and I'll laugh all the way to the bank, taking not only the asset, the property, but their equity as well. So again, that's highly unlikely when you're only lending a max of 60% and the subject property has to cash flow. And of course, I got to recommend any of those who are going to become a private lender, you need a loan servicer. Now, what's a loan servicer? Well, a loan servicer is simply a property manager for your loan. Okay, they handle a lot of different aspects because, frankly, when you make the loan, you don't want to worry about the accounting. You don't want to worry about collecting the payments and depositing the check, right? You don't want to worry about issuing the borrower a 1098 mortgage interest statement at the end of the year, right? So you're going to hire a loan servicer for a very, very low cost. It's an initial startup fee. They range, but the one I work with is about $50. A loan servicer has a nice website where the borrower can set up a username and password and log in, set up automatic payments. They also have a nice portal for you as the lender to set up an account on the servicer's website where you can upload your personal information, your bank account, so when the servicer collects those monthly payments from the borrower, they just simply turn around and ACH them to you. Now, the servicer does charge a monthly fee very similar to how a property manager would. The one I use charges a flat rate of $20 per month. Okay, so when you collect some of those payments I talked about, you know, $628 on that loan in Florida, you know, it's a small price to pay for a lot of services that they handle. More than worth it. Now, Superior Loan Servicing and the Note Servicing Center, which I have on the screen now, those are just two that I've worked with. There are hundreds that are out there, and you're certainly welcome to work with whomever you'd like. Right? If you just Google loan servicers, you're going to find hundreds, maybe thousands of them. They all have a little bit different structure and how they work, but they're all, at the end of the day, pretty similar. Okay. Question I always get to. How does Marshall Reddick Real Estate make money? Right? We're in business to make money. We want to provide solid investments for you, but we're just like any other lender. Right? We make a loan fee, commonly referred to as points for facilitating each transaction. In our long-term Mailbox Money program, the fee is paid by the borrower, right? And the fee is 3 points. And a point is just 1% of the loan amount. So to describe that for you guys, very easy. $100,000 loan, 3 points would be $3,000. And again, it's the borrower that pays that. I get questions all the time from lenders. What does Marshall Reddick charge us to become a lender and get access to those loans that they have available? There literally are no fees, and I bite my tongue when I say that because there are a couple fees, but what I mean by that is that you don't pay us, right? So the only fee you're going to have to invest in one of these loans is the wire transfer fee your bank is going to charge you to wire the loan amount into escrow. I use Bank of America. My bank charges me $30. Okay, it's just a part of doing business, right? The second time you're going to ever have a fee is that when the borrower ultimately pays off your loan, okay, you're going to have to release your lien on the property. And what I mean by lien is when you make a loan, borrower signs a trust deed or a mortgage. That's recorded in the county where the property is located, right, making your loan a public record so that the borrower cannot sell the property without paying you first. So at the end, when the borrower has repaid the loan in full, you have to sign a release of that lien. That release will then get recorded in the county where the property is located to expunge the prior lien that you had against the property, so the new buyer, whoever has the property then, has free and clear title. I hope that made sense, but I'm happy to address any questions when we get to the end of the presentation. Okay? So the reason I bring that up is because there will be a fee for that. That's a document that needs to be notarized, and a notary, at least in today's market, is going to charge you $10 for that notary. Okay, so again, no fees to Marshall Reddick in order to participate in these amazing opportunities. Okay, let's talk about the role of Marshall Reddick. We talked about it a lot through the presentation tonight, but we provide the lending opportunities for you. I'm constantly talking to borrowers day in and day out. I'm looking at property, I'm analyzing it, we're making decisions, and then I have a pool of lenders like yourself, and I know their criteria, and I'm feeding out these loans constantly. They go very, very quickly. So once we have a conversation and you're ready to do this, you have to know that you have to have some speed in which, because there's a very high demand for these investments. Okay, so we provide the opportunities. We communicate clearly through escrow with all parties. That's you, the lender, with the borrower, with the realtor, inspector, appraiser, all of these different parties. We handle that. Okay? We coordinate the closing with escrow and the attorney. Some states require attorneys, like Georgia, but same concept in terms of escrow. And ultimately, the big one on the screen is number 5. In the event we ever had a default, again, so unlikely, and we haven't had any defaults to this point, but understand that we would be here to help you. We don't just expect you to go out there on your own and to flounder or figure it out. Right? You as the lender will ultimately be the decision maker, but I would hope that you would come back to me, Patrick Prunty, and Marshall Reddick for advice, right? So that we can get you in touch and have a conference call with the attorney to understand the process of the foreclosure in that particular state, what the costs are involved, etc. Now, you guys are going to ask a lot of questions, I know, in terms of, well, how expensive is it and all that. We can get to those questions, but for an example, right, in Texas, the attorney that I work with charges a flat $1,500 to process the foreclosure. That includes everything, including up to auctioning the property at the courthouse steps if the borrower doesn't cure the default. Again, a default is never ideal and happens so seldomly that I'm not concerned with it. And in the event I did have a default on the loans that I'm doing or one that my investors are doing, we will foreclose on that property and we will take that collateral. The stock market can't say the same. So that feeds into my last and final question. What's the absolute worst case scenario? I get asked this constantly, guys. So what's the worst case scenario? Bottom line, you end up owning the property. So when you're looking at making these investments, ask yourself this question. Would I be comfortable owning that property in that market for the amount I'm lending against it? If the answer is yes, it's a no-brainer because literally you're going to have to do nothing and you're going to collect Mailbox Money, between 7 and 8.5% over the long term, which is better than the average annual return, what 90% of you have earned over the last 25 years. Make sense? Okay. I'm going to throw my contact information up on the screen, and then I'm going to grab some questions. Maybe I'm not going to have any. I know that I answered quite a few questions. Let me get these up here. Okay, so I had questions about who pays the loan fee. Okay, so we've addressed that it's the borrower who pays the fees, right? They cover all the escrow fees too, the title insurance, the escrow, everything. The lender simply wires in the money. Good question. Everyone's asking about first or second position or junior lien holders. These are all first position loans, right? So we don't allow any junior lien holders as well. So the documentation would state that no liens subordinate to your first position loan. So again, that's just goes to even further minimize the risk. Good question. Again, these are all first position acquisition or refinance loans. Do interest rates go up? No. These are fixed rates. Okay, so 7, 7.5, or 8.5% are fixed rates. Okay, now we certainly have some uneasiness in the interest market, right? Fed raised rates fairly recently, but it's been a long time, and I don't foresee the rates going up astronomically for many, many years to come. I mean, I just can't see us getting back to the late 80s where we had 18% interest, right? But nonetheless, over the last 25 years, you guys are talking about 3 and 6%. I don't think that earning 7 to 8.5 is a bad payday. Had a question about reviewing the ways to become a lender. Okay, so a purchase money loan is number one, right? So that would be like Joe Blow has a self-directed IRA and he is buying 123 Main Street. Okay, the property purchase price is $100,000. He has $60,000 in his IRA. He wants to use $40,000 of that to purchase. That's the 40% down of the $100,000 purchase, and he signs a contract with the seller for that property, and then we go into escrow, and then he's looking for a $60,000 loan for 60% of that $100,000 purchase. And as the bank would in bank financing when you're buying a property, lender wires in the funds to escrow, borrower wires in their down payment and closing costs, and the escrow holder settles the transaction. That is a purchase money loan. Okay. Second would be buying a loan that's already been originated. You're buying it in the secondary market. Okay, so let's give an example. Let's say Marshall Reddick Real Estate as a business is holding a portfolio of 10 loans that we originated as purchase money loans, and we've held them between 1 and 10 years, right? And they're performing, borrowers making the monthly payments, and you want to come in and buy that loan from us and take over those monthly payments. We could sell you that existing mortgage paper, and we would do that through escrow. Okay, so that's how you'd buy a loan in the secondary market. And third was the refinance or cash out refinance. Okay, so again, common strategy I like to use. I have borrowers that buy property at foreclosure auction, right, or a situation where they have to pay cash, or they already own the property free and clear. Okay, so there are no liens on the property. Right? They come to me and say, here's my property, we have it appraised, we look at all the specifics, we make sure it cash flows, and then we would be comfortable lending up to 60% of that appraised value. We would go into escrow again for that transaction, right? Lender would deposit the agreed upon loan amount, mortgage or trust deed would be recorded in the county, encumbering that property for the loan amount, and the borrower would start making monthly payments. Simple as that. Those are the three ways. And again, you're just simply becoming the bank. Hope that was clear. All right, I think may have gotten to the questions, at least the ones that are recurring. Appreciate you guys all being on the call tonight. Again, my name is Patrick Prunty. It's been my pleasure being with you. My contact information is on the screen. Shoot me an email. My office is here in Newport Beach. For those of you who are local, come down and see me. Again, I love face-to-face and be looking forward to speaking with you guys and helping you guys become the bank and collect mailbox money. Have a great night.